Hello, I'm Ralph Moore, the CEO of Brokerhouse, and welcome to our Life Insurance 101 Training Module 1. The purpose of this training module is help to you and your assistants become more comfortable in talking and selling life insurance. This 20-minute video will help you understand how to quote the insurance, apply for it, and then also go through the policy provisions so that when someone asks you a question, you have an answer. You should be able to answer 98% of the questions that are given to you if you know the answers from this quick little training module. So let's get started. The first question is, what is life insurance? And it is something that pays out a sum of money either on the death of an insured person or after a period of time, say maybe the insured's age 100 or age 120. Now let's talk about the different types of life insurance. The first one is term insurance. Then we have whole life, universal life, indexed universal life, and variable life. I'm going to group those last four, whole life, universal life, indexed universal life, and variable life, into what we would call permanent life insurance products. Those products typically build cash value and have a level premium for the lifetime of the insured. Those products are going to be outside the scope of this module and will be covered in another module. This module is going to speak solely to term life insurance because about 80% of your request will be for term life insurance. The others will be life for cash value. Those permanent policies, again, will be covered in another module. So we talk about term life insurance. What is it and how does it work? Well, there are really three questions that need to be answered by you or the client. If you answer two of them, the computer and proposal systems will spit out the answer for the third question. For example, the first one is, how long do you want the coverage to last? And by that, I mean, how long do you want the premium for the coverage to stay level? The most common of these are now 10 years, 20 years, 30 years, age 100, or age 120. Age 100 and age 120 are actually universal life contracts, but they act, smell, and taste like term insurance. So we're going to call them term insurance for our purposes today. The second question is, how much coverage do you want? Do you want 250,000, 500, a million, 5 million? How much coverage do you want? And then the last one is, what is the annual premium that needs to be paid? So those are the three questions. How long do you want the premium level? How much coverage? And then what is the annual premium? And we need the answer to two of those three questions. Now, what other effects are there on the premium? Well, it could be smoker or tobacco user versus the non-smoker or non-tobacco user. Companies have gone to non-tobacco instead of non-smoker because there are 3 or 4 companies that will still give dippers, chewers, smokeless tobacco, whatever, non-smoker rates. But the mortality for tobacco users is much greater than that for non-tobacco users. Therefore, the premium is much higher because remember, these premiums are tied closely to the mortality that the insurance company sees. The next would be standard or preferred. Standard means that the client exhibits average mortality, average health of the general population. A standard might have someone who has diabetes under control, or maybe they've had a past cancer history, something such as that. Preferred is someone who has little or no medical history, taking little medication, has a good family history, good driving record. Those would be your preferred risk. Now, beyond standard, we get into substandard. So someone may have had a more serious health condition, heart attack, uncontrolled diabetes, a cancer history recently. Those things would add extra premium. And those are typically either in a letter or number form. Some companies use the tables A to P. Other companies are 1 to 16, but they're the same. For example, table B is the same as table 2, depending on whether the company used the letter or the number nomenclature for substandard business. The other thing that may affect the premium is an exclusion. We don't see these much anymore, but there have been exclusions in the past for private pilots, and sometimes you can still exclude those and get the preferred best rating class for private pilots. But those are things that would affect the premium. So let's talk about how this works. So as an example, Susan is willing to spend $100 a month for a life insurance policy, and she wants $500,000 of death benefit. So those are two of the questions that we talked about. First is what is the annual premium, even though she's giving it to you in a monthly amount. The second is how much death benefit, which is the $500,000. Now, the third part of that is, does that get a 10-year term, 20-year term, 30-year term? What does it get? And then the last question is, how does the preferred and standard non-tobacco affect those premiums? We have developed a chart that I'm going to show you here that shows what would happen for $500,000 of level term coverage. Since Susan is 50 years old, a 30-year term policy would cost $110 a month. That's a little bit more than her budget, but kind of in line. She might be willing to do that. Or if she wants to go 20-year term, that's $65 a month. If she doesn't get preferred, but instead comes in at a standard rate, she'll probably go for the $97 a month here for a 20-year term, because she's not willing to pay the $170 a month that the 30-year term would cost her. As you can see, if we go back to the 50-year-old preferred, the longer the term period, the longer that premium remains level, the higher the premium. 10-year term is $42 a month. 20-year term is $65 a month. 20-year term is $110. If she wants to go all the way to age 100, it's $353 a month. Now, let's say that she's 60 instead of 50. What you'll see is there's nobody that's going to write a 30-year term for her. It's either going to be 10 years or 20 years or the age 100. And that 10-year term would be about $92, again, within her budget if it was $100. So that gives you some idea by looking at this table. The older that you are, the more expensive it is. The longer that you want the level term to be, the more expensive it is. Now, the next step would be how to apply for the coverage. And we have, how to quote the coverage. The first would be that you can get it on your phone. There's a link that we can send you, and then you can put this on the phone, and you can go in there and enter in the name, the date of birth, the amount of coverage, and the length of the term, and it will give you the premium for the coverage. That is one way we can help you put that on your phone, and you can do it in seconds while you're sitting in front of the client. The other way to get a request is to send us this paper form that we've developed, and you can submit that to submit@brokerhouseins.com, and it has the amount of the coverage. You can request multiple amounts if you don't know. It has the name, the state, height or weight, date, gender, just a few small items, and then we can send you that quote back. But this would give you a quote for about 12 to 15 different companies for your different clients. The second step after that of getting the quote is, once it's sold, is how do you apply for it? Well, we have developed this drop ticket that is in paper form, and you can complete this, and it requests a little bit more information than it did to get the proposal, because now we start talking about who the beneficiaries are going to be, the address, the Social Security number, whether they have any health history. But this is a 2-page form that, again, you can send to submit@brokerhouseins.com, and we will then get the carriers, submit it to the carriers, whichever carrier you've chosen, and the client then will either get a phone call or request to do an exam. Now, most of these policies will require an exam. Certain face amounts and ages can go through without an exam, but about 95% of them are going to need that exam. But some of them can get approved in a couple of days if there's not any significant health history. So now you've learned how to quote either via the phone or a paper app. Now you understand how to submit using this drop ticket. You can actually apply online, but again, that is beyond this module. We'll have a separate module talking about how to apply online and lead you through those steps. The next thing I want to do is go through some of the actual policy provisions. This will help you feel more comfortable with insurance, being able to answer those questions when a client asks you something, so you don't have to say, let me get back to you. If you know the things in these 8 or 10 slides, you will be able to answer 98% of the questions that people have. So the first thing that I want to show you is what we call in the life business, the deck page, or page 3. In the property and casualty world, you call it the deck page. The page 3 in the life insurance contract tells you everything you know about the policy. It gives you the policy number, gives you the insured, it gives you the issue date, it gives you the amount of coverage, it gives you the premium, how long the premium is level, it gives you almost all the information you need. Also gives you the underwriting class on that page 3. But that is pretty well known in the life side. Let's go into some of the policy provisions. And the first one I want to cover is the owner and beneficiary. In 90% of your cases, the owner is going to be the insured. But the owner could be a trust, it could be a business, any number of people that could be the owner. Maybe it's a spouse. But the owner is the one who has all rights in the policy. And the rights would be to continue paying the premium, to do a conversion, which we'll discuss in a few minutes. They're able to name the beneficiary. If the policy had cash value, they can take a loan against the cash value. But that's what the owner does. It has all the rights of the insurance contract. That is different than the beneficiary. The beneficiary is the person or entity that receives proceeds in the event the insured passes away during the contract. The beneficiary does not have to be the owner, but they have to have some relationship to the insured. You can have primary beneficiaries. You can have contingent beneficiaries. Contingent beneficiaries would receive benefits in the event the primary beneficiary predeceases the insured and it was never changed. For example, you might see a wife as the beneficiary and children as the contingent beneficiary. You can name multiple primary and multiple contingent beneficiaries. Now, let me also say that when you name the beneficiaries, the insurance companies want you to name them as a percentage of the death benefit rather than for an amount of death benefit. And those percentages must equal 100%. So if you have 3 children for a contingent beneficiary, you need to name one of them as 34%, the other is 33% beneficiaries. The next thing I want to cover is the suicide exclusion, which is probably the most misunderstood provision in the whole life insurance contract. It says that if the insured dies by suicide in the first 2 years of the contract, the company can deny the claim and only refund the premiums. Now, you've seen on TV shows or movies where someone dies of suicide, they say, oh, the insurance is not going to pay. Well, that is not true, because the suicide exclusion provision is a required provision in the insurance contract, and it is required to be 2 years from the date of issue or date of reinstatement in every state except Colorado, where it is 1 year. That is a requirement. It also leads us into the incontestable clause, or sometimes the contestability clause. That is very similar to the suicide exclusion. It says if your client misrepresented their health in order to get the insurance policy, they forgot that they were being treated for cancer, or they forgot they'd had a heart attack 2 months ago, and they die in the first 2 years, the company has, again, the right to contest the claim and only refund the premium. But that, again, also is only for the first 2 years of the life insurance contract. It's kind of called the prudent person rule. So if they knew that they had something that was affecting them and they die in the first 2 years, the company can go back, find that, and contest the claim. So it asks the person to be honest when they're applying for the coverage. If you're honest and disclose all the doctors, then the onus is on the insurance company to find out and order any medical records. Next, we'll go to the grace period. This is in the event someone fails to pay a premium, either a monthly or quarterly premium. Maybe they change their bank draft or they fail to make a quarterly premium. They have 31 days on a term policy to make up that premium, and the policy stays in effect without any evidence of insurability required. Now, if they go beyond the 31 days, we're going to talk about that in a minute, but for the first 31 days, all they have to do is to make good on the premiums. In the event death occurs during that 31-day period, any amounts owed the insurance company is taken from the death benefit. So they had a $500,000 premium or $500,000 death benefit, and the premium was $1,000 and they failed to pay it, but they die in that grace period, the death benefit proceeds would be $499,000. If they go beyond the grace period and maybe they go 90 days and fail to make a payment, all is not lost. They can go back and request a reinstatement. However, the reinstatement is subject to new evidence of insurability. They have to pay all the back premiums and get the policy current. They also are subject to a new 2-year suicide and incontestability provision. But they go back to the original policy with the original premiums, original face amount, etc., if they'll get approved for reinstatement. But again, this does have to go through underwriting, whereas if they do it in the grace period, there is no evidence of insurability required. Big distinction there. Now, if you get to the end of the term period, you've typically got 3 options. The first one, which is the automatic option, is probably the worst. The policy goes into a 1-year term period renewal where the premiums jump significantly from the initial premium. The longer the premium was level to start with, the more the premium is going to jump at the end of the level period. These premiums are so high, they're almost exorbitant. And unfortunately, the only people that would be able to want to pay this would be the ones that are in extremely difficult health conditions. But that is the automatic option. There are some policies out there now where the premium stays level, but the death benefit reduces significantly. So be aware of that when you're talking about these policies, and that is going to be in the policy page as well as the illustrations when you look at that. Just take note of the difference in what happens at the end of the renewal period. The other option is they have a conversion period where they can go to a level premium for lifetime, one of those permanent policies we discussed earlier in the presentation. Typically, the conversion has to be before age 65 or 70, depending on the carrier. It also has to typically be during the level premium paying period. So it cannot go into the 20th year and the second month and do a conversion. Typically, companies don't allow that. The conversion expiration date is on page 3 that we again discussed earlier. The last option is a re-entry provision. This is not necessarily contractual. It is in some of them, but basically it is you going out and buying a new policy with a new 10, 20, or 30-year level period, which is, again, subject to underwriting, evidence of insurability. The first two, the renewal option and the conversion period, are not subject to evidence of insurability. The re-entry provision is. When you go through underwriting, again, you have a new 2-year contestable and suicide exclusion, but you can do that option. Life insurance is thought of paying a lump sum to the beneficiaries when the insured passes away. However, there's some settlement options that can be exercised either by the owner of the policy prior to death actually occurring, or it can be exercised by the beneficiary after the insured has passed away. If the owner chooses that, the beneficiary is locked in. If the beneficiary chooses these options, they can later change it. These are called sometimes spendthrift provisions because you may have known someone who received death benefits and it was all spent before everything was done that needed to be done. So it keeps the beneficiary from spending through all the proceeds quickly. The first one on this list is on deposit. So the money can be left with the insurance company at interest and be paid out over time. The second option is payment of a fixed amount. So let's say you have a $500,000 policy. The beneficiary needs $5,000 a month to continue their lifestyle. So the proceeds would be paid out $5,000 a month until the money runs out. It would last more than 100 months because the amount originally does earn interest over that holding period. So it may last 120, 130 months, whatever it would be, depending on the interest rate. Option 3 is for a fixed period. So let's say they have an 8-year-old child at home. They want to be sure they're covered for 14 years until that child is 22. Then you can say, I want it for 14 years. The amount of that coverage then would be, amount of benefit, either monthly or annually, would be calculated by the insurance company and sent to the beneficiary monthly. The last one on this list is a life income. This guarantees that the beneficiary will never outlive the proceeds of the insurance policy. So the amount paid will be based on the amount of death benefit, the age and sex of the beneficiary. And a monthly amount or annual amount will be calculated and sent in a timely fashion to the beneficiaries. You can also add a fact that a provision that in the event the beneficiary dies within 10 or 20 years after the insured, someone gets the payments for 10 or 20 years. Lastly, I want to talk about the accelerated death benefit rider, which is the newest provision in a life insurance contract. And this came along in the early 90s to satisfy the AIDS patients that wanted death benefit prior to death actually occurring. So if someone is terminally ill, typically meaning 6 or 12 months or less to live, as specified by their doctor, they can reach in and get some of the death benefit prior to death actually occurring. In my 30 years, I've never had an accidental death benefit rider. What now in the last few years has come along to take the place of this is what we call life settlements. The insured can, or the owner can actually sell this policy in the open marketplace through some of the life settlement companies. The difference is those life settlements when someone doesn't need the coverage or they want to stop paying the premiums. Those life settlement companies are in open bargaining to figure out what the death benefit is in current value. This accelerated death benefit rider is for those that are terminally ill. A slight difference, but significant difference. The accelerated death benefit rider is a better, if you're terminally ill and need those proceeds, is a better buy than going to the life settlement companies. So that's the provisions of the life insurance contract in a term insurance policy. If you want to know more, please contact us at David Moreland or D Moreland at Brokerhouse INS. That's D Moreland at Brokerhouse INS. Or you can call us at our Birmingham office or Atlanta office. And then we're also on the web at www.brokerhouseins.com. If you need me, again, my name is Ralph Moore. I'm the CEO of Brokerhouse. We're happy that you've joined us for this training module. We hope that you found it beneficial, helping you be more comfortable in talking about life insurance, how to quote it, how to sell it, and then also answering some questions when they ask you. So thank you for your time today.